Hello everybody, I'm Danielle Keynes, and today we're going to solve another problem in Accounting 1030. It's E3-8. They're asking us to journalize the adjusting entries that are needed at December the 31st for all of these situations. So why are we doing adjusting entries at December 31st? Well, we're doing adjusting entries because we are using the GAAP principle that says that we need to do accrual-based accounting. So under GAAP, it says that we need to accrue revenue and accrue expenses. What that means is that any revenue that was earned, we have to record the revenue. So whether or not we receive the cash is irrelevant. Under accrual-based accounting, it says when we earn that revenue, we must record it. Likewise, when we incur expenses to earn that revenue, we must record them in that time period. Again, it doesn't matter when we pay them, when we pay the cash, it matters that we have incurred those expenses. So that's why we're doing accrual-based accounting. There's nothing in those there's nothing that's going to trigger us to make those adjusting entries. We have to think about all of the adjusting entries that need to happen before we do our financial statements and put them in our journal. Remember that accrual-based accounting never involves cash, because cash transactions, we would record them when they happen. Cash happens, we'll record it. So we're only going to record, they'll either involve a revenue account, so we're increasing revenue, which is a revenue is a credit account, remember, or we'll be increasing an expense. So any entry that we do will be increasing revenue, crediting a revenue account, or increasing expenses, which is debiting an expense account. So that's always going to have one of those accounts in our journal entry. So that's kind of a hint. So let's look at our first entry. So it says on June the 1st, we collected $48,000 rent in advance. We debited cash. So I'm showing here in the T accounts what we would have done on June the 1st. So we would have debited cash for $48,000 and credited unearned rent revenue, because our customer paid us, our tenant paid us for 1 year's rent in advance. So they gave us the full $48,000. On June the 1st, when they gave it to us, we didn't earn any of that on day one. So we have to put it into a liability account called unearned rent revenue. Now, at the end of the year, before we do our financial statements, we have to adjust that unearned rent revenue because now we've earned it. And let's look at, they paid $48,000 in rent. So 1 month's rent, if we calculate that, would be 48,000 divided by 12, because this is covering 12 months rent. So 1 month's rent is $4,000. So in June, we earned $4,000. In July, we earned $4,000, and so on. So we have to account for 7 months: June, July, August, September, October, November, December. So we're going to that we have earned 7 months of that revenue. So I'm going to take this 4,000 multiplied by 7. So we know we have earned $28,000 of that unearned rent. It's always important to look at the time period. So we're adjusting for the whole year, except we didn't get this rent until June the 1st. So it's only 7 months that we're adjusting for. So we've got rent revenue. That's our credit account where we have rent revenue, and we're going to debit our unearned rent revenue. So we're going to adjust this account for $28,000, and we're going to record it as revenue. So let's go over to our journal entry and make that entry. So we have December the 31st. So that's all of our entries are going to be adjusting entries on December the 31st. We've got several of them here to do. Our debit, like I said, is going to be unearned rent revenue, $24,000, 28, sorry, 7 times 4, 28,000. So $28,000 is our debit. And we're going to, our credit account is rent revenue. So remember, it's always a revenue account or an expense account. And in this case, it's a revenue account. We're earning revenue, that rent revenue. And our explanation is going to be record rent revenue earned. Here they're giving the exact calculation. You don't have to do that, but it's good to have as much information as you can provide. So we're recording the rent revenue that we earned for those 7 months. So let's go on to the next entry. So B, interest revenue of $2,400 has been earned but not yet received on a $60,000 note receivable held by the business. So we loaned somebody $60,000, that's what it's saying, and they haven't paid us the interest yet, but they owe us at the end of December 31st, they owe us $2,400. So our revenue account is interest revenue. That's the kind of revenue that we're earning. And it's going to be, somebody owes us money, so it's going to be a receivable account, an asset, which is going to be our debit account. And we're going to call it interest receivable because it's not accounts receivable, because accounts receivable is only for our customers, and this is a different kind of interest. It's interest from, you know, whoever took on this note from us. So we're going to have an interest receivable, which is an asset, and which is a debit, and we're going to have interest revenue is our credit account. So let's go over to our journal entry. We have interest receivable. It's our that's our debit account. $2,400 we were told is what we are owed, and interest revenue is our revenue account. Again, we always have one revenue account or one expense account. And we'll say, you know, that's to accrue interest revenue earned. Notice that our debit account has to come first. Our credit account comes second with a little indentation, a little couple of spaces here. And then we have our explanation. We skip a line and then we go to our next entry. So let's see what our next entry is. It says salaries expense is $7,500 per day, Monday through Friday. And the business pays employees each Friday. So Monday to Friday is their business week. They have expenses $7,500 a day. This year, December the 31st falls on a Wednesday. So let's look at our Monday, Tuesday, Wednesday, Thursday, Friday. They said December 31st falls on a Wednesday. So our expenses, they told us, are $7,500 each day. So let's see what that is. So here's our $7,500 for each day of that week and the last week of the year. But remember, we're doing our expenses, our financial statements. Our year end is December the 31st. So on December the 31st, we owe our staff these 3 days. So we owe them $22,500. So we're going to have a salaries expense for those 3 days, Monday to Wednesday, of $22,500. And we're also going to, we're going to owe it. So we're going to have a liability, and we're going to call that liability salaries payable. Again, it's not accounts payable because that's our suppliers. This is the account that we used for our suppliers. It's salaries that we owe. So we're going to name it salaries payable. So let's go over and do our expense. It's going to be, our expense is always a debit account, and it's for $22,500. And we're going to do salaries payable. That's our liability. And we're going to say to record the expenses, to accrue the salaries expenses for 3 days, 7,500 times 3. We'll skip a line. We'll go to the next entry. Equipment. Okay, so equipment was purchased last year at a cost of $200,000. The equipment's useful life is 5 years. So when we purchase an asset that we're going to use into the future, we set it up as an asset. So we would have debited our equipment account. And each year, because this equipment is going to be used over the 5-year period, we're going to amortize it, which we're going to have an expense. So we're going to have a fifth of that expense every year. Right now we're doing it for the full year because this was purchased last year. If it was purchased, let's say, July 1st, we'd only be doing it for half a year because it would only be the second half of the year. But we purchased it last year, so we know we're doing it for the whole year. So how much is a year? Well, it's $200,000 divided by 5 years, they told us. So 1 year's expense is $40,000. So you'd think, okay, so can we credit our equipment account for $40,000? No, we can't. So under the cost principle, under GAAP, we have to leave the original cost of the equipment in its asset account. So we need to leave it there. So because of that, we use something called a Contra Account. So it's a companion to the equipment account. and it's called accumulated, it's not spelled right, accumulated amortization, and you can put the name of the account here, equipment, to say that this is the companion for the equipment account. And what we do is we put $40,000 in the accumulated amortization account. It's a companion. So on the balance sheet, you'll see $200,000 less accumulated amortization of $40,000 for a net $160,000 value. But notice that you do not use the asset account, the equipment account. You use its companion. It is an asset account, unlike other asset accounts that have debit balances, because it is a companion to the equipment account. So, so you would always show it along with the equipment account. Don't make the mistake of calling it a liability account because it's a credit account. It is really an asset account. It's a contra companion account. So what's the, we're doing either revenue or expense here. So in this case, this is an expense. And we call the expense amortization expense. So the expense is going to be called amortization expense. And it's for $40,000. And we're going to use that companion account to our asset account called the accumulated amortization account. You can put equipment after it if you like. It's a good idea. They don't here in this book. And then it's to record amortization for the year. Why they have -0 here, if they said this was going to be worth $50,000 at the end of the 5-year period, you would have to subtract $50,000 and only amortize the $150,000 divided by 5. So it's whatever, if you think it's going to have a useful value at the end, you would subtract that and not amortize it. But here they've told us that it's going to be 0 at the end, so that's why we took the whole $200,000. So the next entry is on September 1st, when we paid $6,000 for a 1-year insurance policy. We debited prepaid insurance and credited cash. Okay, so on September the 1st, which is an important date we need to think about, we paid $6,000. So this was our entry. We debited prepaid insurance for $6,000 and we credited cash. So this was on September the 1st. At that point in time, we can't call any of this as an expense because we didn't incur any of it, because it's day 1, September the 1st. We just paid it and we paid for a full year. And the prepaid insurance account is an asset account. So here we just traded an asset for an asset. So this is for 1 year. So how much is this insurance policy for a month? We'll divide that by 12 to see how much is it costing us a month. So it's $500 a month. How many months do we have to accrue for? Well, this was September the 1st was when we bought this insurance policy. So in this current year, we're going to use September, October, November, December. So we are going to have 4 months of this expense. The rest of it will be next year. So it's going to equal 500 times 4. It's going to be our expense for this year, $2,000. So our insurance expense is going to be $2,000, and then we're going to credit our prepaid insurance account by $2,000. So our expense is insurance expense. So our insurance expense is for $2,000. And we're going to credit our, we're going to credit our prepaid insurance account by $2,000. So we're to record our insurance expense, $6,000 times 4 divided by 12. We did divide it by 12 times 4, which is the same thing. And notice that, when we do that, we have $4,000 left in our asset account after this adjustment. So the $4,000 is still prepaid, and we'll expense that over the following year, in the first 8 months of the next year. Okay, they tell us the business owes interest expense of $7,200 that will be paid early in the next period. So at the end of December 31st, they're telling us we have an interest expense of $7,200 that we haven't paid yet. Maybe our payment is due, January the 1st of the following year. But at this point in time, we owe $7,200 that we haven't paid yet. So we're going to have an interest expense, $7,200. And what account are we going to use? It's going to be a liability because we owe money, and the account that we're going to use is interest payable. So just like before, when we had salaries payable, here we're going to call it interest payable because it's interest that we owe. We're not going to call it accounts payable. It's not a supplier that we owe. It's interest. It's, for example, a bank or something like that. And this is to accrue our interest expense. We come back, the unadjusted balance of the supplies account is $13,500. So this is the supplies account at the start, or where it was before we're making our adjustment. In this book, they treat supplies as an asset. So we purchased, supplies previously, and we have $13,500 left in the account. The total cost of supplies remaining on hand on December the 31st is $4,500. So what that means, we really need to carefully think about this, because what they're saying is that the supplies that are left right now is $4,500. So they're telling us the balance in that account. They're telling us the end balance is $4,500. So if the end balance is $4,500, how much did we use? Well, we used $13,500 minus our ending balance. So we used $9,000. So just be careful about how they word this, because they could have said, we used $4,500, and then that would be your credit to supplies. But in this case, they said the ending balance was $4,500. So they're having us calculate how much we used. So we're going to credit our supplies, our asset account, $9,000, and our expense is going to be supplies. So here's our supplies expense, and it's going to be for $9,000. And we're going to credit our supplies, our asset account, for the $9,000. And that's going to be to record our supplies expense for $13,500 minus the $4,500 that was left. So these are all the entries that the business needs to do to record before they do their financial statements. Like I said, there's nothing that's going to trigger you to do this. You have to think about, look at your unearned rent revenue of, we had, what was that we had here? You're going to have to look at this account of $48,000 and say, okay, how much should I earn? You're going to have to think about any interest that you might owe. You're going to have to think about your staff. Did you pay them right up until the last day? If you didn't pay them for these 3 days, you need to accrue it. You always have to look at your assets, like your long-term assets, your equipment and such, and figure out what amortization do I need to record. Anything that you prepay, you're going to have to think about, okay, I prepaid this insurance, $6,000. How much did I use of that? How much am I going to expense? Do I owe any interest? Are there any loans that we have, notes payable that we have? What about supplies? Did we use supplies, or how much supplies did we use? So you're going to have to think about all of these things in the business and record them. Also, just remember that we're doing this because we're doing accrual accounting, which states that you must accrue any revenue. So you have to record revenue when it's earned. You have to record expenses when they are incurred. It doesn't matter when the cash transaction takes place. It's when you earn it and when you incur it. And the other thing that it always involves either increasing a revenue account or increasing an expense account. So let's look at our accounts. There's our rent revenue. We increased revenue. Here we have interest revenue, increasing revenue. Here's our expense. We increased an expense. Our amortization, there's an expense. Insurance, expense. Interest, expense. Supplies, expense. So we're either touching expense accounts or we're recording revenue. So that is problem E3-8 of Accounting 1030, and I'm Danielle Keynes. Thank you.